equities can always say रिश्ते में तो हम तुम्हारे बाप लगते हैं, नाम है equities. So the fixed income, is not going to be subservient. Say that हम काले हैं तो क्या हुआ, दिल वाले हैं types, no?
Welcome back, listeners. Today we have with us Ms. Bond of the Indian markets. We have with us Ms. Lakshmi Iyer, who's the CEO of investment advisory business at Kotak Investment Advisors Limited. So she has been with the Kotak Group for over 22 years, and prior to joining Kotak, she has worked with Credence as a research analyst, where she was tracking corporate bond markets in India and generating research reports. So she holds an MBA from NM College, Bombay, and she is recognized as one of the top 25 influential women in asset management in Asia by Asian investors. I know that women's cricket Premier League has been going on, but here we have someone who is also in her own Premier League, as she featured on Forbes India as well with the W-Power 2022 towards the end of the last year. So I follow you across social media platforms, right? And I know for the fact that you enjoy food analogies, Bollywood analogies. And another thing is that you love roller coasters as well, right? But having said that, how has been the recent roller coaster ride in the financial markets been? What is your take on that? I mean, I would just like to start with that.
Sure. Thanks, Charmi, and hi to all the viewers and listeners. Roller coaster is something, which gives me adrenaline rush. And I say this to everyone. If you are a teetotaler, how do you get your kick? So I think that's where the roller coaster of the financial market clearly excites me. There are uch niche, but that doesn't matter because, as I said, I have been to so many roller coasters in the world, pretty much every theme park, whether it's SL World as a school child or, into other various Disney land and other theme parks. There will be lots of ups and downs, but it's very, very important that if you have the patience, and more importantly, if you dissect things in a manner which is, pretty methodical, I am pretty convinced that it will be a happy ending.
Yeah, it's lovely to have you over here. And I can see that equity markets are quite similar to an Bollywood item number. Like there's a lot of shore sharaba, but over here in the debt markets, it's pretty calm and, it's quite similar to meditating. So is it India's time to sit back, relax and meditate? And if yes, how long should she sit back and relax?
No, so my view, Darshan, is that India continues to remain an oasis in the desert, given that we are seeing multiple sandstorms in the desert right now. And why I say that is because there is clearly, I wouldn't say a decoupling effect, but clearly from every aspect, whether it is geopolitical, there's a lot of halchal on the geopolitical front, for example, elsewhere in the world. But there is relative calm. I would say somebody can ask, itna sannata kyun hai? But the reality is that that is how the geopolitics is, favorably inclined towards India. That's number one. Number two is, I know it's a cliche, but clearly, if you look at Indian demographics versus some of the rest of the world, again, we, score a 5-star. So in that kind of a thing, there could be some hitchy moments in the interim, and which is what we are witnessing right now from a risk class perspective in case of equities. But yeah, I think it's very important. You have to keep reinforcing and tell yourself that all is well, which is the reality also, despite these intermittent hiccups. And second, you have to believe in the faith of the long-term story. And I think that is what equity as an asset class, it's not for, 10 hours, 10 weeks or 10 months. It is more for a 1,000-day plus kind of an investor, or more for a 5-year, 7-year, 10-year plus kind of an investor who truly believes that equity is the Red Bull, which is the most needed in your portfolio, contrary to, basically, if you need caffeine boosters for your energy, I think that's what equity does to your portfolio.
Well, I agree that it is the Red Bull, but currently the bulls have been making the markets red. So in equities, as far as we are concerned. But having said that, right, globally financial conditions have tightened. As central banks are accelerating the money policy normalization to keep inflation or to cool down inflation. But in this current scenario of high interest rates, we understand that equities will take a backseat. I mean, that is something that is a given. But where does debt market stand? Because the global markets are showing strains today, and investors, I think, have become risk averse. So in such a scenario where recessionary fears are there, interest rates are rising, and there is a constant war going on between inflation and growth. So who's going to win this war, and where do debt markets stand?
Very, very pertinent, and very relevant for today's times in terms of discussion. Clearly, the world, when it comes to the entire macro picture, is in some sort of a bhul-bhulaiya mode, where you are clearly trying to ascertain which side inflation is going to. Of course, it's globally now trending on the lower side, no doubt about it. But the biggest tigers, I would say, of 2022 actually were central bankers, and their role was so high that we actually saw pretty much the entire globe rattle with high interest rates. As we come into 2023, it looks pretty certain that we are closer to a plateauing out. When I say closer to a plateauing, there could be some more rate hikes in the offing, especially as far as the globe is concerned. But clearly, are we going to continue that relentless hike, which we saw in 2022? I would say extremely unlikely. So we are in that cusp phase where you are in the part of the liposuction phase, as I call it, where at a point in time, the globe actually pumped in huge steroids in the form of liquidity. And now is the liposuction phase. You need to be very mindful as a central banker that, yes, there is an inflation song that they're all singing, but you must not stretch the cords too much, that you in the pursuit of doing liposuction, that the economy should not go into malnourishment. So I think that is the phase we are right now. And in that kind of a phase, clearly fixed income stands tall. So I would say that equities can always say, रिश्ते में तो हम तुम्हारे बाप लगते, नाम है equities. So the fixed income, is not going to be subservient. Say that हम काले हैं तो क्या हुआ, दिल वाले हैं types. No, it's that kind of a mode, saying that हमको भी थोड़ा इतरा दो. So the reason being that when you are at the plateau stage, and as and when that pivot happens, we still can't see the pivot as far as central banks, especially in the US, is concerned. Even in India, if I were to say that maybe there could be just one more rate hike is what our sense is, because we are doing way better fundamentally in terms of our inflation numbers versus the globe. So I think in that kind of a thing, on a risk adjusted basis, very near term, and when I say near term, I'm talking about the next 3 to 4 quarters, the potential on a risk adjusted basis for fixed income to outperform equities could be reasonably high. But as I said, very, very important to not go for the overkill on either sides. And that's where asset allocation clearly plays its role.
Right. So very well pointed out on that note. So I understand that you mentioned that equities are a long-term play and 10-year, 5-year, 7-year horizon should be there. But for a tactical investor, if I'm looking at someone who's looking at, say, the next few quarters only, how would you suggest him or her to kind of rebalance or rejig their portfolio in the current scenario? Just as a follow-up to that answer.
So, Charmi, I won't say that basis very near term one has to keep rebalancing, because rebalancing is done only on couple of accounts. One is, has your goal been reached, number one? And number two is there a massive dislocation in your portfolio? Assuming you started at a 70-30, 70 equities, 30 fixed income. And due to market movements, assuming that 70-30 has got a little bit distorted, I would say that is where the course correction, irrespective of where the markets are today, you need to do that course correction. And that discipline, I think, is extremely important. So I think often investors get swayed away by greed and fear, and these are the two biggest impediments to our wealth creation process.
So there's the process of mark to market in the funds, as I know that. So if the market is going up, the returns are higher. If it's going down, you are losing out on the money. So how can one And this might also lead to a place where the returns are quite similar to the entry yield, like the yield where you entered, you'll be making the same amount after maturity. So how can you beat that entry yield or create an ideal portfolio with that fund?
Again, mark to market, it's glad you brought this point because it's seldom appreciated. So, for example, there are two types of funds for a case in fixed income. One is an actively managed, which is what most of the fixed income funds in the industry are. And then there are these passives, which are in the form of, say, fixed maturity plans, which are closed-ended, or target maturity funds, which are open-ended in nature. Now, the beauty of this category of funds is it allows to mitigate interest rate risk, which is this up and down kind of a movement to a large extent. A credit, of course, is a function of what is there in the underlying portfolio. But as it solves for the market, the answer is no. It will still give you that same butterflies in your tummy, that roller coaster feeling. It will still give you that depending on what duration you have chosen. But that's not the be all and end all of life, because if we have selected, say, for example, a fund which matures in 2000, we're in 23. So assuming, say, it matures in 2026. And let's assume it's a Government of India security portfolio, which is obviously the highest in terms of risk. It's a sovereign risk. So, even Yamdev can't come from Yamlok and take away those returns from you, because you have sorted for the credit risk, you sorted for the interest rate risk, because you've locked in this fund to maturity. But there is going to be that movement in your portfolio, because every bond in the portfolio is subject to daily market movement. So we need to really declutter this versus what is available to you on the optics. I'll give you another example just to articulate this point. Last year, if you invested in a target maturity bond fund, which is, say, maturing in 2027. So it was a 5-year fund. Now it is a 1-year fund. And at that time, when you locked in, maybe the portfolio yield was, say, 7%. Today, the portfolio yield might have become 7.5. So the 0.5%, the yield which went up, which means the price came down. And that is showing in your portfolio as maybe a 2%, 3% kind of a return. So one can't come up and tell the portfolio manager, "Yaar, tumne mera return kha liya." We don't need returns. It is just because of the mark to market. So you have to stay the course. And that is why staying the course, depending on whichever your portfolio is extremely important. So don't get perturbed by mark to market. It's absolutely okay to have that as part of your portfolio.
Very well put, and that there's an inverse relationship between the yield and the bond price, and that you've put it out beautifully. But having said that, and extrapolating one of your recent LinkedIn posts, I'd like to ask: is this the time to bond with the bond markets then?
Totally. I mean, that tagline is something which is my favorite.
Yeah.
This is the time to bond, no doubt about it. James Bond movies, I know, are not right now available as a new release. But yes, it's worth revisiting some of those that you liked in the past, and try to position yourself somewhere around the 3 to 5 years sort of a duration bucket. That is where we believe. And that's, again, I have a logic for that. If you see, the yield curve is absolutely flat, which means what the 1 year, 2 years commanding, it's pretty much similar to what the 10 years is commanding. There's hardly a gap. And that's what you call as a flat yield curve. So when you are in that kind of a flat terrain, you're okay to gain exposure right at the belly, which is the middle of the yield curve, which allows you to participate in fixed income on a risk reward adjusted basis. It tends to offer lesser volatility compared to the very long end, which is what I call zor ka jhatka dheere se. So yes, go for it. How hard you want to bond, how deep you want to bond, again, as I mentioned, is purely a function of your asset allocation. Don't go completely out of the whack, but don't be too very complacent or very, very conservative. So there is a mid path that clearly you need to take.
I've recently read an article where it says that Indian banks are poised to see a record credit growth of over $19 trillion in FY23. But however, rising interest rates and the tight liquidity conditions could overplay the same. So what is the key to keep the growth momentum running in FY24? Or who is our Pathan in the offing to spring up and give another blockbuster for us?
So, the bank credit growth, if you see, you will be reminded of Jayesh Bhai Jordar. Those are the it's absolutely Jordar kind of portfolio growth that these banks are showing. But to your point, to continue these uchai, it is very difficult because every time you have a high base, bank credit growth in India aggregate is 16 to 17% odd. And if you have to continue to, keep growing at that pace, your deposit growth also has to keep pace. Now, if you look at it, the deposit growth is growing around 9 to 10%, and the credit growth is growing at 16 to 17%. Which is why these banks are actually moving to issuance also in the form of CDs, which is a certificate of deposit market, also is equally important. So clearly the funding pipeline needs to be intact. That's number one, to sustain this momentum. Second is that the global headwinds also need to kind of morph into tailwinds, because you need, both of these. As they say, it takes two to tango. You require a combination of domestic with an interplay or overlay of the global factors to maintain this and, sustain this growth. It doesn't look impossible, but at high altitude, you all know and we are all aware that the necessity for oxygen mask will only keep increasing. Banking NPA cycle, also you need to remember, is at almost a 7 to 8 year low. So therefore, it's important that you originate the right kind of assets to continue and to solve for this and to ensure that this growth path continues to remain fairly intact.
You brought out the topic, for global headwinds and tailwinds. So on that note, I've mentioned this earlier as well, that central bank, has been trying to cool inflation by slowing down economic growth. So the policy that's come out with, right, have to be seen or considered to be reasonable for the general audience. And with that, the government has also been spending trillions to support the economy. But despite all these efforts, growth is still happening at a much slower pace than expected. Layoffs aren't stopping. There's slowdown in China that's also taking place. So in such a scenario where there are so many global headwinds, coming as demons for us, how can an investor retain faith in the economy?
Yeah, I think, Charmi, one thing is very clear. The Indian government officials or the Indian central bankers are not like jadugars, that they have a magic wand in their hand, because there are these other bhedias and villains of the globe, which will obviously keep acting on the Indian economy also, with a lag, with a lead, as the case may be. But despite that, as I mentioned, I started off saying, why is India an oasis in the desert? Because despite the fact that IMF projects global growth to be sub 3%, our caliber to grow double of that is still very, very high. So I think it's very, very important, therefore, to keep that conviction on. There will be, as I said, there will be some of these up and down moments. There will be constant, FPI kind of, foreign portfolio investors, if you see year to date, are actually net negative. They have a net sold in equities. Of course, it's just about 2 months over. We have 10 months more to go. But on the other hand, we have domestic institutional investors or DIIs who are actually doing a juk geo to our, capital markets. So I think there are these multiple tug-of-war cases which will keep happening. But for an Indian investor, if you look at it, and if I can give you global perspective also, if you look at the last 25 to 30 years, India has returned close to about 9% dollar return to the foreign investors. So you can imagine in that period what kind of returns Indian investors have got, because this is adjusting for the rupee depreciation. And I think, therefore, the fundamental faith and the fundamental growth propellers for Indian corporates remain fairly intact. As long as, we don't really do anything, short of a self goal, I think the growth drivers, our demographics, the thrust, look at the kind of thrust that we have had as far as the budget is concerned, the capital expenditure growth, ek fizul kharchi hoti hai that we call, in very colloquial terms, revenue expenditure. But capital expenditure is the more durable way of sustaining this growth path. I think so. All those check boxes are pretty much there. Net exporters of toys. So I think a lot of these things are happening. Rome was not built in a day. So if you expect everything to happen with, like, millennials today want instant gratification, posting a picture on Instagram and then, getting that FOMO feeling, why I don't have likes. Investments are not like Instagram. So you need to really keep your balance intact. You just need to keep telling yourself, there's this movie Sui Dhaga, in which Varun Dhawan chhajje se pani tapak raha and says sab badhiya hai. So you have to actually keep telling yourself sab badhiya hai, because truly sab badhiya hai. There may be some small chinks in the armor, but that should not really derail the journey. It probably would play the gratification, but gratification we will get for sure.
Those are quite a few analogies that I like, and I've loved India's growth story. Having come to Canada over here, I've been in more awe of the credit market. Like, it has grown to a total of 174.3 lakh crore with n number of loans given across like retail, microfinance, and commercial segments. That's mammoth and huge. So like it is making me ponder over two questions. Like, what are the quality of the loans that we have given out? And secondly, what measures the government has taken to prevent any other hiccup in the credit market, like which we have recently witnessed?
So as I said, lending standards have to be obviously pretty, tight, and that's how we've been seeing the banking sector grow leaps and miles. In that, microfinance is, an attempt to get the unorganized sector actually into the organized sector, and it is growing pretty much. It had taken a breather during the pandemic phase because the unorganized sector was quite badly impacted, and relatively it was much higher impacted. But there are, as I said, ways and means to get the unorganized lending to the organized model, and therefore I would say the microfinance lending has assumed a lot of significance. Banks are doing it, NBFCs are doing it. There are these small finance banks who are doing it. Now they've got the status of a small finance bank. These are very important pieces in the ecosystem. So I think to continue growing to say a segment like this or any other segment, I would bring in even the SME or the MSME, which is the small and medium enterprise segment. It's very important to have a broad-based growth. It cannot be a case that only the large market cap companies would keep getting access to sources of financing, whereas the bottom of the pyramid may not really have access. It can happen in patches, and therefore the entire ecosystem has to be there in place. And therefore the underwriting standards, the credit risk parameters, the risk management system, all of that around that have to work in tandem to ensure that we do not have too many catastrophes. You also need to bear in mind when you are lending, it is like I have bought a car. If I keep my car in the garage forever, it'll be absolutely squeaky clean and shining. But if I take the car out, I have to ensure, as a driver, I need to ensure that there are no fatal accidents. A scratch or two here or there is absolutely inevitable. Otherwise, as I said, your car needs to sit in the garage. Similar is the case in lending. You need to ensure, as a fiduciary responsibility, you don't make major accidents, but small scratches here, there, in terms of some delay. How do you handhold the investor? It's important, as I said, therefore preempt some of these and try not to. So the checks and bolts, the bells and whistles, as they call, have to be purely. It's like this, you Google, I'll get back my Rollercoaster example, or even in your in the day-on-day case where you're sitting on the passenger seat, you have to belt yourself. Belting is inevitable.
Right. Just, kind of extending that particular point on the fact that central bankers are not magicians and they cannot, kind of do things in a day or two. So IMF, I recently read an article that was published by IMF, written by Raghuram Rajan. So where he mentions, he mentions out a case for and a case against central banks. But very interestingly, he mentions that when central bankers do succeed in bringing inflation down, we will probably return to a low growth, low inflation world, right? And that is a world that central bankers do not understand or understand less well. So, having said that, I have two questions. One, do you agree to that? And two, if that happens and when that happens, what should central bank mandates look like? I mean, what will happen to the fiscal and financial dominance then?
See, historically, and if you see this globally, the central bankers are always on the firing line. Damned if you do, damned if you don't. That's always been the case, and it's always been the case of those that one goal that you missed versus the 99 goals that you took, and therefore it's a very, very. I mean, getting into the central bank shoes is extremely, extremely therefore hugely vulnerable because they have to be constantly on the firing line. Having said that, if I give you two perspectives, one is from an India standpoint, we saw the inflation, villain or the monster coming pretty much way ahead of the globe. That's number one, because when the world was still growing balance sheets, it's our central banker which actually ceased doing these open market bond purchases. And back in a year back, September 21, when, as I said, the world was actually trying to pump in more steroids into the system. That's number one. Number two is a bulk of this phase of inflation that we have seen in the last couple of years is to do with supply side constraints. It's to a very, very lesser extent to do with the demand side. And we've learned, all of us have learned in economics in B school, that central banker actions can solve to a large extent for the demand side problems and to a very less extent on the supply side constraints. But even despite that, in India, we've seen over 200 basis points of tightening and an implied 300 basis points of tightening already. And as I said, the US is still not in a mood to relent. They might not be in fourth gear, but they're certainly not in the neutral zone. So I think this tug of war will keep continuing. At some point in time, it will come as the dog wagging the tail or the tail wagging the dog. But either which ways, the tail belongs to the dog and the dog is part of wagging the tail, is the way I believe it. And hence, I would say that the central bankers should also not go into such a, I would say, tight-fisted regime that growth falters. How? And that is where this constant debate of the economy, specifically in the US, going into a soft landing or hard landing is being discussed. I would say it is okay to grow a little less when you are taming a beast called inflation. But when the bounce back happens, I think you need to be right there with your torch, saying that, if I were the lead as far as rate hikes are concerned, I am also going to be the torch bearer as far as rate cuts are concerned. And therefore, that point of pivot is going to be extremely important. Historically, we have seen it takes every acts with a lag into the economy, whether it's a rate hike act or it's a rate cut act. And there is typically a period of hibernation, and that period could last at least 2 to 3 quarters. So I would say it's okay for the central bankers to err sometimes on the side of caution, but to ensure that inflation is tamed at the earliest. Extremely important.
So I think the ideal tug of war is between the equity and the debt markets. Given that we have there's 52% of the total investment is in the deposits, and with that the interest rates are rising, the yields are rising. So my question is how sustainable are these yields going to be given the historical spread of the yields and the repo rate? So whenever you reach a horizon, you see many more horizons right in front of you. So what is that India horizon that you currently look for us?
So my view is that the higher interest rates are here to stay for some more time. But is it going to keep relentlessly rising from the current levels? I would assign a low probability for that. See, markets have this very uncanny ability, they have that divya drishti. And if you've seen the movie Drishyam, you will understand what I'm trying to say. They may see things which are not meant to be seen also, but aside of that, they try to discount things ahead of its happening. For example, if someone says April mein rate hike hoga ki nahi hoga, well, I don't know. It's still a toss of a coin. but the markets have already priced that as if there is going to be a rate hike. तो समझो अगर rate hike नहीं हुआ, then there's a higher chance that the markets will actually cool off, where the bond yields can actually come down. So therefore, for India yields, my view is it's not really a tug of war between equities or fixed income. My view is that एक म्यान में दो तलवार रह सकती है. So equities and fixed income have to coexist, because the end use of both of these in terms of your portfolio are a very different thing. Even if you are dieting, even if you're doing intermittent fasting, you can eat a cheese toast. You can eat, a small portion of sweet meal. Both have very distinct and, diverse advantages. And you must have your salads and your greens. So your salads and your greens are your fixed income, and your cheese on toast and your sweet meat is actually your equities. So both of them are absolutely required if you have to make your financial portfolio palatable. So it's not really a tug of war from my perspective, but yes, you will have this constant pull between being pulled. There is a huge magnetic pull for traditional mode of deposits, for example, banking products in India. And with the rates looking attractive, there will be all that charismatic magnetic pull. How much you are going to say opposites attract and actually succumb to that, it's okay to do it in sparing proportions. But to keep that as an overwhelming portion is, again, as I said, is totally a function of your risk appetite. So I think you need to have all of these in sparing proportions in your portfolio.
Right. So we have the salads, right? And the fixed income, and the cheap meals as equities. But in this kind of a scenario, and with going back to a conversation of asset allocation, where do other sectors come in, like real estate, bullion, commodities? How would you what's your view on them?
So Charmi, when you're creating your portfolio, the focus has to be first around financial assets, which is where equities and fixed income really hog that Bahubali kind of a status. And then after that, you have these small, pygmies that have to make up for the entire holistic portfolio. And that is where I would bring in gold, which is like, a soldier to your portfolio. It is your Dwarpal, where everything else goes a kind of down under. It is your tall person standing, or it is your last person standing in your portfolio. So it's absolutely okay to expect gold to expire worthless in your portfolio, because the rest of your portfolio would have made enough and more wealth for you over the next maybe 10, 20, 30 years. Alternates, including, say, physical assets like real estate, have only as much as you can chew, because, as I said, the fulcrum has to be around equities and fixed income in the total wealth creation journey, with a sparing proportion of gold. Insurance has to be treated as a pure risk cover. So have a term insurance, for example, in your portfolio, and again, let it expire worthless. Don't do this greed and fear evaluation when it comes to insurance. Some of these emerging asset classes, I tell people I don't understand that. Somebody asked me the other day, what do you make of crypto? I showed them a thali and explained to them asset allocation. I spoke about the carbs, I spoke about the proteins and the vitamins and the fats. And one cheeky investor asked me, what about the papad? You didn't speak about the papad. And I told her that papad is like that crypto in your portfolio. After you eat, it takes more than 72 hours to digest. So, and I also told her in the same breath, please ask a 20 minus in age about crypto. Don't ask me, because I am a 40 plus. So, you have to be very clear what is going to be your driver for wealth creation. And getting carried away by too many options in your portfolio can be very stylish, but in investments, it's absolutely okay to be old-fashioned.
Great. I think I'll just round up the conversation that we had. I mean, we've had a roller coaster of a ride. We've started from asset allocation to discussing about central bankers to discussing about why fixed incomes. And we ended at the crux of the conversation is sab badhiya. I think you have to believe in the India story, as we've been, coming out with every podcast at the end. The end line is that and nothing else. So believe in the India story and stay invested and keep the faith. Having said that, we'll just round this up with our signature rapid fire round. So quick 2 minutes. So I'll just start. So the first word being market volatility?
Culture,
Wealth,
Brahmastra,
Central bankers,
tigers,
Kotak,
हर दिल में हमेशा से कोना कोना कोटक.
growth versus inflation,
Tug of war, but yes, finally growth will prevail.
credit,
छूना मना नहीं है, but sparingly छूना.
asset allocation,
Thali, assorted thali, go for it.
the SRK of debt market.
I don't know the Shah Rukh Khan of debt market, but clearly this is the time to bond.
the last one from my side, India.
The stock you can never go short on.
The last one from my side is Lakshmi Iyer as the finance minister or Lakshmi Iyer, the RBI governor.
Neither. Lakshmi Iyer as a Kotakite and who loves food and films as much as she eats, drinks, and breathes finance.
Superb.
Thank you.
Thanks for your time, and we're truly delighted to have you on the show. Thank you for coming on the show. Thank you. So much.
Awesome.
Thank you.
Thank you so much.
Thank you so
Yeah.
much.
Bye.
Take
Thank you.
care. Bye.
Bye.
See you. Bye.